my name is Hillary Sunderland, and I'm a Chief Investment Officer of Beacon Wealth Consultants. And this is your June 2021 Mid-Year Market Update. Well, the stock market had a great run in the first quarter of 2021, and those gains continued in the second quarter. For the quarter, domestic large cap stocks led the way for equities, with domestic large cap stocks up 8.55% for the quarter. Small cap, international, and emerging markets all posted strong returns as well. Commodities had double-digit return of 13.3%. And after a rough first quarter, bonds gained some ground as well, posting returns of 1.83% for investment-grade bonds and a little over 4% for riskier emerging market bonds. We assess the likely direction of global markets on an ongoing basis. And quarterly, I'd like to give you a look into some of the most important questions that we ask ourselves in order to determine portfolio allocations. So I'm going to address three different areas today before also talking briefly about some client concerns around inflation. So first, in terms of our market outlook, I'm going to address, does the economy look healthy going forward? Are stocks cheap or expensive? And then are market trends weak or strong? That last one is more of a technical view in the markets, really answering the question, does it look like the upward trend in the market is likely to continue or change direction sometime soon? So let's start with the economy. Here's a chart of the leading economic index, which is intended to forecast future economic activity. As you can see on this chart, historically, the leading economic index, which is the blue line there, turns downward before a recession, which is indicated by the gray shading, and upward before an expansion. So this is an indicator that's commonly used to tell us whether or not we think the economy is going to be going through a rough patch soon. Now, the exception to this working well was in 2020 because the leading economic indicators can't forecast a pandemic-induced recession. That being said, the latest reading in June was very strong. The index now stands above its previous peak reached in January of 2020. And this suggests that strong economic growth will continue in the near term. This strength was widespread across all the variables assessed by the Conference Board, which is the organization that produces this index. Economic growth is expected to reach 9% annualized in the second quarter, with year-over-year growth expected to reach 6.6% for 2021. So those are very robust rates of growth, and overall, the economy appears to be heading in the right direction. Next, we'll look at asset prices, also known as valuations. Again, this helps answer the question, are stocks cheap or expensive? If stocks are cheap, we may want to overweight stocks versus bonds, but if they're expensive, that means we might be prone to a correction soon, or we may want to pare back our stock allocation within our portfolios. So this chart shows the valuation on the S&P 500. The S&P 500 is a measure of the performance of the largest 500 companies in the United States. So it is a bit of a narrower market in terms of our whole global opportunity set, but it's one of the ones that people are most familiar with, which is why I show it here. So as shown on this chart, on a forward-looking basis, valuations are near record highs, meaning that stocks look quite expensive relative to their own history. Now, this may lead you to think that we should sell out of stocks, but that's not the case. The pricing of stocks relative to bonds still remains favorable because interest rates are so low. When interest rates are low, this boosts the present value of companies' future earnings. So with interest rates as low as they are, you would expect this chart to look like it does. And if you're looking back in history there and you're saying, oh, well, the last time stocks were this expensive was during the tech bubble and, the late 90s and into the 2000s, this could be an issue. Remember that interest rates were significantly higher during that time frame than they are now. So when you're looking at valuation charts like this, even though stocks look expensive, you have to look at it relative to other asset classes that you could invest in, as well as really understand the market construct behind that. And also remember, this is just a view of domestic large cap stocks. we invest portfolios globally. So as a client of ours, you aren't solely invested in this market. Valuations in other asset classes, such as international stocks, are much more attractive. For example, international stocks are trading at a 27% discount to domestic stocks. And so we're overweighting that asset class. We are going to where we see the most value globally. So don't be too concerned when you see figures like this on CNBC, because you really have to understand the whole market construct and how the valuations look in comparison to other asset classes. So we'll say we're a little neutral on valuations right now. They look fairly valued. There are pockets of opportunity globally, but they certainly aren't cheap at this juncture. So now let's answer our third question. Is the market trend strong or weak? And we like to answer this question by looking at what's known as market breadth, which is simply a measure of how many stocks in an index are participating in an uptrend. If the number of stocks in a strong uptrend starts to fall, that means that fewer and fewer stocks are holding up the index. And normally you start to see that occur. You start to see market breadth deteriorate prior to a peak in the market. Now, I didn't show a chart on this because they can be a little overwhelming to read, but year to date, the participation across large cap, mid cap, and small cap stocks has been quite strong, which is a very healthy market environment. And what that does is those technical readings confirm what we're actually seeing in the market, that the rise to record highs has been confirmed because you're seeing broad participation. It's not just a few companies that are leading the stock market higher. Now, that being said, over the last few weeks, we are starting to see a fading participation in the rally. And that may foreshadow a market pullback or at least a pause that refreshes. Now, this is not 100%. Sometimes the readings don't come to fruition. Nothing is 100% when it comes to investing. But we are starting to see some fading participation. So I wouldn't be surprised if we see a pause that refreshes or a pullback over the next few weeks. Remember that we actually welcome pullbacks. We need pullbacks to occur in the markets in order to have a healthy market. And so I would like to see one at this juncture. And it's also important to remember that if that does occur, if we get a 5% pullback or maybe even a 10% correction, remember that a pullback or correction in the stock market will not derail your financial plan. Recoveries tend to be very quick. And so you don't need to be concerned if you see that happen in the market. So what are we concerned about? What are you as a client of ours telling us that is concerning you? Well, I would say the number one thing I'm hearing questions about right now is inflation. And so I wanted to address this quickly for you. I'm sure you've noticed that as the U.S. has emerged from the COVID-19 lockdowns, the prices of many goods and services have spiked. And a measure of this is the Consumer Price Index, or CPI, which is shown here. And the CPI has been blowing past expectations, leaving many investors wondering if the low inflationary environment has prevailed for really a generation has finally come to an end. You'll see here that the last reading of headline inflation was near 5%, which is well above the rate of inflation that we've become accustomed to. Now, the Federal Reserve, which is the body that sets interest rates in the U.S., and interest rates is what helps control inflation, so that's why they're important. The Federal Reserve has been saying that this inflation is transitory, meaning that they expect inflation to be elevated, but only for a short period of time due to supply and demand imbalances. And when you really dive into the underlying data behind these CPI readings, you can see where this view is coming from. So, for example, the global shortage of semiconductors has hindered the production of new cars. And after massive fleet liquidations last year, U.S. rental car companies have resorted to buying up used cars to rebuild fleets to meet high demand for travel. And combine this with increased demand from consumers who are flush with cash and who have exited cities due to the pandemic, and you get a pretty large supply and demand imbalance, which leads to very sharp increases in prices over a short period of time, as shown on this chart. In May, the prices of used vehicles jumped about 7%, according to the CPI figures, after an astounding 10% rise in April. So year over year, this is from cargurus.com, their index, just calculated a little bit differently, but their index said that year over year, the price of used cars is up a little over 33%, which is just astounding. And this increase in the price of used cars, when you think about that inflationary reading from the last slide, the increase in the price of used cars accounted for about 1/3 of the increase in the consumer price index. Now, the supply and demand imbalance within the automotive sector is expected to ease in late 2021 or early 2022 as rental car companies are able to restock their fleets appropriately, semiconductor shortage eases, and newer cars can come onto the market. And so we don't expect some of these inflationary pressures to be long-lived. It's more of a shorter-term imbalance. And there are two other figures that have really been increasing that measure of inflation as well, and those are airline fares and auto insurance prices. So if you may recall at the beginning of the pandemic in 2020, airlines slashed fares to fill seats, and the price of auto insurance fell along with the number of miles driven. So now that people are willing to travel again, return to work, the price of both airline fares and auto insurance has jumped as well, which has also increased inflationary readings. So in all three cases, used cars, airline tickets, and auto insurance, the price increases are likely temporary, and they'll likely normalize over the coming months as pent-up demand eases. We've already seen the price bubbles pop in some industries as supply and demand is normalized, such as the price of lumber, which fell 40% in the month of June alone, as people stopped renovating their homes and decided to use their extra cash to go on vacation. So these are some of the reasons why the Federal Reserve thinks that these latest readings on inflation are temporary. And we're hopeful that they will be temporary, but we also aren't putting our blinders on and just accepting this narrative. We are reading other gauges of inflation as well. And some of those don't paint such a rosy picture. For example, input costs are surging beyond just a few select industries as commodity prices have increased. But really at this juncture, the issue is that we need more data. And there are several inflationary readings due in August that will give us much more insight as to whether this inflation will be short-lived or a longer-term issue. So what I would say to you, if you are concerned about inflation, is some of this inflation that we are seeing does appear to be very short-term in nature. We're hopeful that it is short-term in nature, but we're really not going to know much until we get a little bit more data as some of these supply and demand imbalances are worked out. And a lot of that data will be coming in the month of August. So stay tuned on that front. But looking ahead, what are we doing to prepare portfolios in the meantime? Well, if inflation does remain above the Fed's target of 2% through 2022, and then stabilizes at or slightly above 2% thereafter, this would still mark a major turning point for interest rates. Interest rates have been incredibly low over the past decade. And what happens with inflation here is really going to determine the course the Federal Reserve will take on interest rates. And so because of what we're seeing with the interest rates, which I didn't really talk about in this particular market update, but with our expectations for interest rates and where bonds are currently trading, we've already positioned for this. And the portfolios are already positioned for a rise in interest rates should inflationary pressures continue to build. And it's important to note that when you're looking at your portfolio, I'm aware that you don't always know what is in a lot of the funds that you're investing in. Underlying some of the funds that you're investing in, we already have exposure to traditional inflationary hedges such as real estate, gold, commodities, and inflation-protected bonds. So even though you may not look at your portfolio and see a line item that says gold or commodities, just know that in some of the asset classes we invest in, such as a managed futures fund, we can invest in those asset classes when they start to exhibit a strong upward trend. And so we have some of this built in the portfolios already. As we get more information, especially in August, we are prepared to make further changes to the portfolios if we need to. So overall, riskier assets have performed very well through the first half of the year. We believe the economy and the markets have more room to advance given the low interest rate environment that we are in. However, the easy money has probably already been made in 2021. We're already heading into the midterm election cycle, which is hard to believe. And history suggests that we are likely to see a large trading range from now until the midterm elections. And what that means is that the stock market has a tendency historically to move in more of a sideways fashion from about the middle of the first year of a president's term until the midterm elections. So we're just turning that corner. And if history is any guide, we're probably heading into a 12 to 18-month period here where the markets are more likely to move in more of a sideways trading range than this nice, strong upward trend that we've become accustomed to over the last year. But again, we're investing for the long term, and sideways markets happen as well. And we have to take that as it comes. And we will continue to invest portfolios where we see the best value and the trends as they are identified. We thank you for your continued confidence, and please reach out to us with any questions that you may have.